This is day 2 of your lifestyle cruise. Would you please welcome to the stage Nathan Birch, ladies and gents.
Thanks for the warm welcome. I'm Nathan Birch, and maybe we can turn the lights down a little bit here because they're blinding me at the moment.
Lights down.
Just a little bit about myself and a couple of housekeeping rules before I get started. First of all, today I'm not going to be talking about financial advice or anything like that, so everything I'll be saying is just as it is. As a property investor, no bullshit. I do like to swear as well, so if I swear, please don't get offended. I'll try not to do it too much. But other than that, let's get started. Who of you were here yesterday? Who of you here weren't here yesterday? Who of you here don't know if you were here yesterday or not? Okay, all good. Just a little bit about myself. Those of you that were here yesterday, you probably hear similar sort of thing that you heard at the start of yesterday, but I'm just going to run through it quickly. You might be wondering what I'm going to talk about today. First of all, I'll just be starting a little bit about myself, my journey, and why I'm here today to talk to you about. So I'll start about that. I'll be talking about a property market update on what's happening in the market in 2014. A little bit about finance, a little bit about property management, tax and accountancy, ways to make money in property, managing a property portfolio, mistakes to avoid investing, as well as some questions and answers. We're only running with an hour. I think I've got more than an hour's worth of content to talk to you about today. So if there's any questions afterwards and we don't have enough time to answer them all, I'll go out the back and answer them one-on-one with you. So on that note, you might be wondering who I am and a little bit about myself. Nathan Birch is my name, grew up in Western Sydney, made my first $1 million at the age of 21. Got my first property at the age of 18, left the workforce at the age of 24, currently sitting on about 150 properties. Net income from rental side of things, $2 million a year. I like to wear thongs, I don't like to wear suits and, be like any spruikes or anything like that, so I'll just tell you as it is, how I see it. I have a $20 million property portfolio and I've got no rocket science and bullshit about it. So, does anyone here have kids at school? You do? Are they in high school? You want them to be like, get good grades, get a good job, all that sort of stuff. I got 32.8 in my UAI, and in 2002, thanks, I successfully failed high school. Does this mean I was dumb? No, I didn't. I think that I was intelligent, I just didn't care about, Pythagoras, the theorem and all that sort of shit. And English as well, because I'm pretty bad at, writing and all that sort of stuff. So if you get an email from me and it's got a few dyslexic words in it, that's all right. Just a little bit about where I started in the humble beginnings. I grew up in Western Sydney, parents working, hard working. My father passed away at the age of 62, I was 16 years old. It was a surprise package. When my parents had me, they weren't expecting to have another kid. I've got 3 older brothers. They're about 20 years older than me. I never wanted to be a child. My mother says to me now, she's 70 years old, Nathan, you keep getting stupider as you get older. It's a bit like Benjamin Button, I feel, but with it, I started looking at properties when I was 13 years old. I was looking in the Homes Victoria magazines. I got a bit excited about them. I never stuck the pages together, thank God. But it's I like property at a young age. This is my first house that I purchased in 2003. It's in Western Sydney, in a suburb called Hebersham. Anyone know Mount Druitt area of Sydney? You've got a few Westies here, yeah? Awesome, get amongst it. This is my first property. I bought it for $248,000. I'd never been to Mount Druitt before I was about 17 years old. And people said to me, Nathan, you're going to go bankrupt, you're going to go not make money, all that sort of stuff, all the opinions that people had. I bought this house at $248,000. I just sold it the other day. I don't sell properties, I buy and hold. My strategies to buy properties, hold it, have a passive income stream that will just pay for cool stuff, whether it be going on a cruise, having pina coladas, or cool cars and sports cars. I did make a lot of sacrifices throughout my time. Nowadays, I personally own over 40 companies by the B.Invested group of companies, and they range from finance companies, law firms. I set them up over the last 3-4 years. When I left the workforce and I was bored, I had nothing to do. So I got my teams together of my key people, being solicitors, accountants and all that sort of stuff, and formed different groups of companies. With it, this is my first house. I did sell it because it was just time to move it on. Rent on at $600 a week. That thing puts about $200, $300 a week in my pocket after all expenses every week. That's just one deal. I'll run through just a few deals so you get a bit of an understanding of what sort of properties I'm talking about. I'm not here to talk about buying timeshare properties or buying properties off the plan or anything like that. It's all about buying properties that are below market value, that have an upside for capital growth and a good rental return. This thing here, I purchased a couple of years ago in Cairns for $90,000. At the time of purchase, it was worth around 120. In a previous time, a couple of years before that, they were selling for around 200,000. That's for a 2-bedroom unit. Rent on it, $200 a week. It's got an 11% yield. People say you can't buy double-digit yields. They're out there. This property here was one of my earlier properties. The slideshow shows us a black blob on my computer screen. It's got a nice double brick house on it. Purchase price was $232,000. That was in Penrith, in the LGR of Penrith. Current market value is about $400,000 to $450,000. Rent on it's about $400 per week. I didn't put the yield on it because I prepared the slides in a hurry. This property here, this was in Shelby in Western Sydney. I purchased it for $205,000, probably about 3 years ago. Market value on it now probably $320,000, $330,000. It's in a private area. Rented out. It's been rented out since day I bought it. The same tenants for $360 a week. It's a 9.1% yield. Puts $50, $100 in my pocket every week. My properties aren't all in shitty areas that people might say, oh, you can't buy properties out in Western Sydney or whatever. I've got waterfront properties. These things here, they're at the entrance. I bought a developer bank repo stock. I bought 14 properties, 12 of them for clients, 2 of them for myself. $212,100. Market value of purchase around $320,000. They were selling for about $450,000 at the time. Rent on them $340,000 per week, a yield of 8.3%. So that's a new property, modern property, depreciation, upside for growth, and below market value on purchase. Nowadays I buy different sorts of properties. This thing here I just settled on recently. It's a block of motel units. It's got 13 units in the Newcastle region. Purchase price $650,000, market value $1.2 million. Rent on it $3,500 a week, and the yield I didn't put in there, but it's about a 25% yield on the purchase price. So brings a good return. This thing here, I just checked my bank account this morning actually. This thing here I just got $88,000 rent for the year for this thing. I bought it for $465,000 just under a year ago. What it is it's a shop in between the 2 trees are there. It's a shop, it's about 250 square metres. I've got the ability, got a concrete slab on the roof, to build one day if I get bored some units on top like the shop next door did. Right across the road is water, and just a very conservative market value on it would be $1.1 million. That's based on a rental return of 8%, which is pretty conservative for a commercial premises. This thing here, I had to buy this in cash recently. It's a motel block in the Blue Mountains. 1.665 million, market value, estimated market value $5 million. This is based on the fact that each of the units are worth about $120,000 a pop. They could be worth $150,000, but let's be conservative. Rent on it $8,000 a week. So you might be asking how I can afford to buy that sort of stuff cash. The fact of it is that I've built a foundation portfolio of properties, bread and butter properties, Western Sydney, other blue chip sort of areas, whether it be on Brisbane, Gold Coast, those sorts of areas. Where I've been able to build equity in the properties, buy something for 200, it's worth 250, 300, they go up a little bit, worth 350, 400. As you can see by the earlier properties that I put up, there's a couple of them. Pull out the equity and be able to use it as capital to purchase this sort of stuff cash. That's just a little bit about myself. If you missed yesterday's presentation, it will be on YouTube. Probably tomorrow or Monday, and I'll have the link up later so you can go and check it out and get a bit more about myself and what we spoke about yesterday. Just a little bit about the market, what I see for the course of 2014. I think that the market in some areas is going to boom, and in some areas it's going to plateau, and in some areas it's going to tank. Does many people in here have invested properties at the moment, or yeah? Okay. Any mining towns? No. Phew, that's good. I can talk about it pretty bad. Mining towns, some people have been spruiking off the plan, mining towns, properties that are, got high yields, and I won't touch anything that's unsustainable. And I think that mining towns are unsustainable sort of properties, and now it's a sort of time where the market's getting smashed, where properties will sit there for a long period of time, not rent out, higher vacancy and very hard to sell. Personally, I think that over the course of 2013 we saw Sydney and New South Wales rise quite a bit in price and value. I think that there's still a bit more growth in Sydney and New South Wales. I think Queensland is very under market at the moment. There's a lot of properties which are selling for $50,000 to $100,000 more 5 years ago. There's a lot of buyers and activity in the marketplace at the moment. And I think over the course of 2014, southeast Queensland, further up north, big key areas of Queensland will see a fair bit of growth. Does anyone in here think that we're in a property bubble? That's it. I think that personally, like some people get scared about the market being like America, or we could have a housing bubble or a housing crash or whatnot. I personally think if we go back through stats and numbers since 2003, 2004, like Sydney's been in a flat time, it's actually stepped backwards and it's just started to pick up. So I personally think we're just around where we were 10 years ago in the marketplace. So there's a fair bit of room to increase in value and capital, and also just on the fact of interest rates. I personally think that when property markets do go up in value, that interest rates, properties actually go to the highest point when interest rates start to rise, but then once they get up to a certain level, they'll come backwards. But yeah, it's sort of counter-cyclical. But personally, I don't think we're in a bubble. I think there's a lot of upside for growth, and as long as you buy the right properties in the current market, usually right, you'll make some money. But like any sort of business, I look at property investing as a business. I look at each property as a separate business. It must make money for me, must be with a purpose. If I look at business stats, 9 out of 10 fail in 5 years. I think the property investors, looking at the numbers of what I pay for lots of properties that I've purchased myself, a lot of property investors lose money in their properties and they sell them in 5 years' time. So what I always say is to make sure that you do a lot of research in your properties and make sure that you're buying things that are in line with your goals and in line with your purpose to help you achieve financial independence. Spoke about areas of growth, areas of decline, interest rates. Does anyone have any feedback on interest rates? Interest rates are going to go up. Interest rates are going to go down. Yeah. I personally think that we're at 2.5% interest rates from the Reserve Bank of Australia at the moment. I don't think that will go much lower, but I do think lots of things in life. But personally, looking at statistical data coming in from the stock exchange and the cash rates and how they project their cash rate, I personally think we'll be pretty stable throughout the course of the year. If it goes up or down, we'll only be 1 or 2 basis points moving, so 1/4 or 0.5% either way. But I think we'll be pretty safe to say that by the end of this year we'll be in the 2% somewhere, whether it's up a little bit or down a little bit. I wanted to talk about different areas of property investing today, and just touch on a few things just based on some questions that came in from yesterday's discussions. So I just wanted to go through different areas of conversation. Today, first one being finance. Does anyone have any questions on finance? No. I'll go through a few things. From a finance side of things, a lot of people think, you just go out and get a loan, get the cheapest interest rate. The cheapest interest rate is best for you. Personally, I don't think much about getting the lowest interest rate or which bank to go through. The most important thing to me as a property investor is getting the bank that's going to give me the best terms and lending environment to deal with. So what I mean by that is if you've got a goal to create a passive income stream of $50,000 a year, $100,000 a year, and build a passive property portfolio, is the most important thing is to be able to build that property portfolio. And saving $1 or $2 a week on your interest rates is good, but that's not the most important thing. The most important thing is that you you're being able to expand your property portfolio, be able to tap in your equity when you want to, and the bank's being able to understand your goals and being able to lend to you. So it's important not to focus just on the lowest rate, which a lot of people do, but I think it's the biggest trap that people fall into. The biggest thing is to make sure that the bank's going to lend to you to achieve your goals. So once again, achieving your goals could be buying 10 properties that's going to provide you an income of 50 grand a year, 100 grand a year from 20 properties, whatever the case may be. Make sure the bank's going to support your goals. Choosing the right broker or bank manager, I should write or bank manager there. A lot of people just go to a bank and they go, okay, I'm going to deal with my friend that, they're a mortgage broker, or they work in a bank, or whatever the case may be. The most important thing is making sure that you've got the right broker to understand your goals. If your broker's just doing home loans for mum and dad, it's going to buy a house to live in or a couple of properties or whatever, they may not be up to the skill set of being able to get the loans for you. So very important to understand that your broker that you choose is going to have lots of investors that are doing the same sort of goals as what you want to achieve. So this is that bit. And serviceability, I think a lot of you in the stage, I don't know, does anyone think that they can buy 10 properties in the next 5 years, 3 years? Issues with getting financed? You'd like to? Okay, good stuff, good stuff. With the serviceability, I spoke about and touched on this a little bit yesterday. A lot of people will go to the bank and get a pre-approval for 300,000 or 250 or 400, whatever the case may be. If you got to the bank and they said, look, you can borrow 400 grand for a property, you might be thinking I can only buy one property or maybe two properties if I'm lucky. What you've got to remember is that buying a property I've got three main rules of buying a property. I'll catch up to them later, but I'll say them now. Make sure that every single purchase that you buy is below market value. That gives you an exit strategy in case you have to dispose of the asset, to be able to get out and still make a bit of money or at least recoup your costs. Make sure that it also gives you an upside to pull some equity back out for your next deposit to recycle the capital. Make sure the property's got a strong cash flow. The reason why it needs to have a strong cash flow is, I think, that negative gearing. Who likes negative gearing? Who's heard of negative gearing? Yeah. Accountants talk about it, off the pen salespeople talk about it. I think negative gearing is fucking shit. It's really bad. It's basically negative gearing is saying that you get a tax loss on any sort of losses you make on your property. So if you're losing $100 a week, the tax department won't give you, like say if you're paying 30 cents on a dollar, they'll give you 30 bucks a week back on your tax for holding that property. The question that I ask is, if you were to buy a business, would you see Jerry Harvey or Richard Branson or anyone, Donald Trump, anyone going out to buy a property or buy a business that's going to lose money to potentially get a tax deduction? No. Like, why would you buy a property that's going to enslave you further at work? And if your goal is to get $100,000 a year passive income, why would you buy a property that's going to take you further away from your goals? And probably doesn't need to be positive cash flow from day one, as over time your rents will naturally increase if you buy in a good area. And as your rents increase, it'll be, if they go up $100 a week, if it's neutral cash flow today, it goes up $100 a week in 5 years' time. There's $100 a week positive cash flow in your pocket. You've got 10 of them, there's 50 grand a year positive cash flow. Having a property that has a strong cash flow, each time you buy a property, it'll help out with your serviceability, because what will happen is that you can have the affordability to buy more properties. The bank will look at that as an income for you. So it's very important to make sure that you buy the property below market value, good strong cash flow, and upside for capital growth. At the end of the day, you don't want to be buying a property for 200 grand and in 10 years time it's still being worth 200 grand. You can buy 10 properties at 200 grand and they go up to 400 grand, you're turning $2 million into $4 million. I thought of it when I was 18 years old. If I was going to have 10 properties by the age of 30, they go from 200 grand up to 400 grand. I'll turn 2 million into 4 million. I thought who at the age of 30 would be able to have $2 million. And that was my little goal at the start, and I thought I could never achieve it. I got there at the age of 22, around there. But it's something that I'm still only 28 at the moment. I've got 2 years left. I don't know where I'll be. I might be at 200 or 300 properties by then. More millions and extra zeros at the end of it. But it's just a matter of having a plan and being able to stick to it and work towards that. From a finance side of things, if you've got questions, first of all, I'm not a financial advisor, but I do have a finance company where I've got brokers, the best brokers in the industry, which understand how lending work. A lot of my brokers come from the back end of the bank. They used to be credit assessors at the bank, so they've got the skill set and all that to be able to understand what you want to achieve. The company's called Zinger Finance. I don't have any cards for it. I don't have any glossy brochures for that. But I'm just telling you, if you check out B.Invested.com, you can check it out there. But from that side of things, it's important to make sure that your finances down pat. Has anyone had any without their properties in here, has anyone had any problems with tenants or property managers or? Yeah. What was your horror story, if you don't want me asking? Okay. Did you have insurance in place or? Okay, so the insurance didn't cover the damage. And do you want me asking which brand? Okay, I won't say it on the mic because it's getting recorded here, but I can't talk about insurance policies and stuff like that. I'm not a financial advisor, but I'll give you my feedback on insurance policies as well. My experience with property managers, you can find some really good ones and you can find some really shit ones. They're not even worth. Like people talk about, oh, let's get a 5% instead of 6% management fee or 8% or whatever the case may be. The shit property manager isn't worth paying a cent to. I wouldn't even take them for free. A good property manager is worth their weight in gold. The reason why I say that is I've had property managers which have got me. I've bought properties which have had low rents by $50 to $100 per week, less than what the market should be. And they say, oh no, the tenant's good, you leave the tenant in there, all that sort of stuff. As a property investor, every dollar that you get in your portfolio is most important. Having a property manager that can manage your tenants, they're going to be the ones that actually make sure you make money or get you in financial independence, or the ones that are going to stuff it up and keep you in your job. And my thoughts on property managers is someone that's going to be looking after your best interest as a landlord, maybe someone that's got properties as being your property manager, so they take care of it of pride, like their own property. Someone's going to be able to push up rents regularly, proactively, not you ask them to increase the rent. So I personally go through my own property portfolios on a quarterly basis and look up on realestate.com, Domain, and all the websites and see what's happening in the marketplace, see how many properties are for rent, see how many properties in your sort of category are still vacant, how long they're sitting on the market for, see what sort of rents you're going for, and if you do have the ability to increase, you don't want to increase the rents more than market price because you're going to, push the tenant out of the property, but you want to make sure that you're keeping up to date with the rents, because $10 per week on a property is $520 per year. If you've got 10 properties and it's only $10 per week, that's $5 grand a year in a pay rise that you're not getting, or the property manager's screwing you over on. So, very important. As for landlord insurance, which we were just talking about beforehand, it's very important to get a good landlord insurance provider. I won't say which one I use, because it's being recorded once again. However, I don't go through the run-of-the-mill insurance companies that you see there and you'd insure your house and your car with. I always use a separate landlord insurance company. There's a couple of them. They start with the letters T and the 2 words, or 3-letter word with an E at the front of it. They're the 2 best insurance companies that I find. They just specifically look after tenants. There's no premium that changes, like if you have a claim. What I found is once with a 4-letter company which insure cars and actually come and fix your car as well, I had a tenant, I had a property that got vandalised, and the tenant, all my policies, let's say for instance you've got 10 properties, you've got your car insured, you've got all those sorts of things, you've got a no claim bonus. So you make a claim because the tenant's ripped you off $2 grand, and you've got 10 of your policies or 20 of your policies or 100 of your policies go up by $100 a year next year because you no claim bonus and shit. It's not going to be the best thing for you. The rental, the landlord insurance only sort of companies, they have a set figure and the premium's based per state, and it's the same for everyone. So, and there's set excess as well, and they cover everything. So it's important you get the right insurance policies in place. If you have a good property manager, they will recommend to you a good landlord insurance company, the ones that they use. So, with a property manager, it's important to understand how your property manager will think and how they operate and how they work and all those sorts of things. The reason why I say that is that if you're increasing your rent or you're asking your property manager to increase their rent by $10 per week, they've got the relationship with the tenant. The tenant comes in every week and they go, here's the rent, how you going, how's the kids, how's your dog, whatever, it's the relationships with the tenant. What will happen over time is that you're just the landlord. You might talk to them once every couple of months, whatever the case may be, and you ask to put the rent up, and it'll be like you're putting the rent up on my friend. If the property manager does that, I wouldn't go and shoot them, but I'd sack them and get rid of them. With it, the important thing is that I just realised, I told you all that I got crap grades at school. If you look at how a property manager works, I've got like a typo there. Didn't have a spell check on my slideshow. I do know how to spell property. It's my favourite word. With it, when you increase the rent by $10 per week, the real estate agent's going to have the tenant coming in and complaining that, my rent's gone up, I can't afford it, whatever, whinge. The property manager, if they're charging you 7% plus GST, that's 77 cents that the real estate office is going to get. That's what their boss is going to get towards the business. The thing is that the property manager is going to put up with all the complaining, all those sorts of things. So the boss getting 77 cents a week, they're not going to see a cent of it. And if they do see a cent of it, it's not worth them to put up with the problem. So the thing is that you need to be proactive, you need to get a good property manager. I've got a property management firm called Blink Property. I set that up because I had to shit with a lot of property managers out there. And the thing that I see is that if I can proactively increase my landlord's rents for them, that fee of 7.7, 8.8, whatever it is, will, if I increase the rent by 10%, my fee increases by 10%, my business's cash flow increases by 10%. So it's just an extension of my property portfolio being my business portfolio. So it's something that it's important that you've got a property manager that's proactive, helping you out to grow your rents, grow your passive income, and increase the property portfolio. Also, another thing is selecting a tenant. I personally don't have any pro formas with a tenant. I always leave it up to my property managers. I've got a good, solid property manager in place. I always say to the property manager, find out a little bit about them. They know not to call me if the tenant's a pain in the arse and going to be trouble. If the real estate agent's happy with the tenant for me, because I've got the trust and confidence and the respect for them to be able to do the best job for me, I let them choose the property, to choose a tenant in there, because if the tenant's going to stuff up the place and cause trouble, it's going to be the property manager's job to fix it up. So it's pretty simple to do that. On the other end, if you've got a property that's in the housing mission suburb in one of the rougher parts of across Australia, you're not going to expect to get a tenant, two double incomes of executives that are on 6-figure salaries move into your property. It's important to get the right tenant to your right property, and bad things happen in any sort of property. So I've got some properties that are in really rough areas with lovely tenants that have had in there for 5 years, 10 years, those sorts of things. I've got properties that are at waterfront mansion sort of things and stuff, which have had tenants, have wild parties, heads go through walls and all that sort of stuff. They can afford drugs and stuff like that, so they have wild parties and trash places. So there'll be good and bad in any sort of tenancy or any sort of property. It's important to have your insurance policies in place and to make sure that a good property manager being able to handle that and manage it. So, any questions at this point? No? Okay. Accountancy and tax. I'm not an accountant. I can't talk to you about accountancy advice. However, what I can say is we spoke about negative gearing beforehand. And we talked about how it's shit, and a lot of accountants actually like talking about negative gearing and recommend negative gearing. But what you've got to remember is that you need to have a property savvy accountant, because the difference between having an accountant that just does a tax return to try and save you tax, or an accountant that will be there to help you build wealth. And what I mean by that is, if you go to your accountant and say, look, I paid 30 grand tax this year, I paid 40 grand, I paid 100 grand, I paid 10 grand, whatever the case may be, the accountant's role is to try and decrease that. I'd be asking my accountant, how many properties do you own? How many clients do you have that have multi-property portfolios? Because I've had accountants that have had no properties, and they say, yeah, buy some negative geared properties, get them off the plan, high depreciation, like you're paying a premium, you're losing cash flow every week. It's the worst investment that you could ever make. It's going to tie you to your job for an extra 20 years, not get you out of there in 10 years. Having an accountant that goes, okay, this is a holistic approach, this is what you need to do, buy a property that's got, a bit of depreciation, trying to save you tax is the biggest thing. If you're paying tax and making a profit, then, you have to pay tax, so it's the way it is. It's important to have a good accountant. Structuring your properties. Some people buy properties under their personal name, some people buy them under trust, some people buy them under the self-managed super fund. There are all different ways that you can purchase properties and acquire them and hold them. I've seen some accountants which let investors buy 20 properties, 30 properties, 40 properties, and never let them buy under trust. I think that's a bit crazy, because having your properties under a trust will actually give you a level of asset protection, so if someone was to sue you, it wouldn't be as damaging, depending on how it's all structured. And also being able to pass on your wealth to future generations. So if you're building a big multi-million dollar property portfolio, you want to pass it on to your children or grandchildren or nieces and nephews, whatever the case may be, having it under certain asset classes, under the structuring, will be easier for you to pass on to other generations instead of having to sell them off and pay taxes and all that sort of stuff. Capital gains, I got asked that yesterday in the crowd. Does anyone have any problems paying capital gains tax?
No, because I've made money.
Exactly. I hate paying capital gains tax. I hate paying any sort of tax, but we've got to do it. Like, you're going to make money, you're going to go to work on Monday morning after we get off the cruise, put up with your boss talking crap, annoying you, whatever the case may be, ironing that shirt, brushing your teeth, feel like you're going through Groundhog Day every day, or paying some tax because you made a profit and not have to go to work. I think I know which one's better. There are ways of minimising tax and all that sort of stuff. If you've got a good accountant, they will be able to help you save tax and put you in the right direction. Negative geared versus positive geared. If we look at anything, if something's negative, I think it's shit. If something's positive, it's going to be good. Pretty much the same thing with investing like that. Negative geared properties I wouldn't touch. They're costing money out of your pocket. We've talked about that. It's no good for you. Some negative geared properties are okay if you're going to buy a property with the purpose of, or intents and purposes of, being able to develop it, do a cosmetic renovation and turn a profit on it, but not just buying a property and praying and hoping that it's going to go up in value. I'll talk about that, I'll take it to the next level. If you're buying a property for say $400,000, $500,000 in Sydney, you're renting it out for $350, $400, $500 a week, and it's negative cash flow by $200, $300 a week, which a lot of people do hold properties like that. $200 to $300 a week is $10,000 to $15,000 per year in expenses and losses. What you will be doing is, in 10 years' time, there will be 100 or 200,000, 150,000 worth of capital growth you're going to have to break it even and get your money back. So it's pretty bad. Positive geared is going to put money in your pocket every week, be able to buy your peanut coladas, go on cruises, not tell your boss where to go and not have to go to work on Monday. Land tax is something that's going to be payable on anyone that's a property investor. Some states are different for structuring purposes. Important to speak to your accountant about that as well. Once again, I don't mind paying tax for not making money. And SMSF, I think everyone in this audience, if you don't think you can get into property today, because you don't have any money saved up or whatever the case may be, self-managed super fund. If you've got money in your super fund, you can buy property under your super fund. It's important to have an accountant that can be able to look after that for you. Different ways to make money in property. You can buy a property and sell it, make yourself a bit of money. I'm not a big fan of buying and selling. The reason being is you don't hold the asset after you've sold the property off. So if you bought a property for 200,000, sold it for 300,000, great, you've made 100 grand. At the end of the day, I'd rather be a buy and hold investor, which is what I do. As time goes on, you're buying a property portfolio. You might have 20 properties, 30 properties there. They all go up by $100,000, $200,000. You make yourself millions of bucks and still hold the asset and have passive income coming in from there. So if I look at my initial strategy of buying 10 properties for the price of $200,000 each, and they're worth $400,000 each, that's $2 million into $4 million. I've made $2 million worth of capital growth, and we've got to sell them off, pull out equity from revaluing the properties and refinancing them. But the thing is if those properties were neutral cash flow from day one, and they were to have an increase of rent by $100 per week over 10 years, that'd be 50 grand a year passive income coming in forever. So if you build that property portfolio, build a passive income stream for yourself, I'd rather take $50,000 a year for the rest of my life than having a quick win of doing a bit of hard work every year to try and make, $100,000, $50,000, or whatever you're chasing. For me, when I first started, I used to have to do sweat equity. I was on 35 grand a year. I worked 2 jobs, bought my first house at the age of 18. I've been working since the age of 13 because I was excited about buying property. I had 35 grand saved up, bought my first property, worked 2 jobs to try and save a second deposit, third deposit, and I did renovations and tried to create sweat equity because that's what I needed to do. I didn't get born with a silver spoon in my mouth, which I'm thankful for. The biggest thing for me is having a passive income, so I can go off and do things how I want, when I want, why I want, and all those sorts of things. My biggest happiness way of making money on properties is buying them below market value, so I can create instant equity to be able to redeploy my next property. I've made a profit from day one.
How do you buy below market value?
How do I buy properties below market value? Good question. I covered off that a lot yesterday, which I'll show up the video. I'll show you a link on YouTube where you can watch the video when we get off the boat. As for buying below market value, understanding the market, like we used to spend about 8 hours a day actually researching properties and what's for sale and what other things are selling for. I personally have a lot of networks and connections within real estate agents over 10 years of buying properties. When I buy a property, I used to do training on how real estate agents work, a lot of real estate agents sales training. So I understand how real estate agent thinks, what a real estate agent wants to hear to be able to buy a property seamlessly. At the end of the day, a real estate agent wants to sell a property, not there to take 10 different people through, trade what people think. If you were to get an extra $10,000 on a purchase price for the agent, that results in like $200 to the offers, it might result in an extra $20 to the real estate agent's bank account. If you can walk into a real estate office and say, here's my property, I'm ready to buy the property unconditionally, sign a contract, exchange it straight away, no bullshit, you build a level of respect and trust with the real estate agent, they will tend to call you and say, I've got a property for sale, do you want to buy it, before it even hits the market. Nowadays, for myself personally, I deal with administrators, banks, to actually get bulk deals. So I'll explain a couple of them as I get through a few more slides that I've done recently. Holding a big property portfolio, people might ask, how can you manage it? Like it becomes a bit of a full-time job, and that has happened for me. I employ staff in my office just to open my mail, so I come in with a bag of shit every day, like council rates, water rates. You get 150 council rates and the hit, it's 150 grand. It's important to have systems and filing and folders and all that sort of stuff. If I was to have to do my mail and my paperwork myself and tax work, I'd be able to take care of it pretty easy because I've got some systems and procedures in place. It's like when you go to Macca's and they have a cheeseburger they spit out for you. They don't spit it out, they make it very quickly. It's the same patty that they put on a Big Mac or a cheeseburger and all those sorts of things, which will, there's a system in place. Very important to make sure that your bills are paid on time. You don't want to get any credit defaults or anything like that. So important to ongoing bills, make sure they're paid. Insurance is in place. I had 3 properties burned down last year. The first thing I did before calling the police back when the detectives called me and stuff was call the insurance company to make sure my insurance policies were paid and up to date, everything was in order, because insurance policies, I've seen it happen when people's insurance lapse and all those sorts of things. What can happen is you get busy in life, and if the insurance is not in place, something could go wrong. If they do go wrong, we don't intend for them to happen. That's what we have insurance for. I personally review all my properties annually to make sure that they're performing well. And if I need to cut a property or get rid of it because I think it's not performing as best as what or it's exceeded its growth, it's going to sit there and lay dormant for the next 10 years. Sometimes I do cut the fat and get rid of the property. I make sure that my property managers, go back to property management, they pay my council, my water, my strata, and all those sorts of associated bills that don't come to me. I don't have to pay for them. They come out of my rent, and it comes back to me with a paid stamp, everything attached to my rental statement from the real estate office. And land tax, people talk about land tax. Land tax is something the government, they make Ned Kelly look like a gentleman, the government do. When they charge a land tax, it's just stealing money off you. Something you have to pay, it's the cost to do a business, and each state's different, but if I make money, I don't mind paying tax. Mistakes to avoid whilst investing. A lot of people, just like anything, emotion will get you killed. Always make a logical decision when buying a property, when doing business. People make emotional business decisions, they make silly business decisions and end up getting themselves in trouble. Make sure you take the emotion out of the deal and always make logical decisions. It's all about a numbers game. I see a lot of people walking with bingo. It's not like bingo, but property is all about being a numbers game, where if the numbers stack up, make the deal happen. If the numbers don't stack up, walk away from the deal. Sometimes people let their ego get involved. Personally, I'll still rock up in my thongs, rock up in a $500 ute. I've got $200,000 sports cars and stuff like that. I don't, go up to a real estate agency and go, I want to negotiate on 4. I can't afford to buy this property and my car's worth more than the property. Like, it's always take the ego back out. A mindset. A lot of people have a mindset, I can't do this, I can't do that. A negative mindset. Some people want to try and get rich quick. Colonel Sanders, if you look at KFC bucket of chicken or whatever, we haven't seen that for a couple of days on this cruise. But when you look at your KFC packet next time, you'll never see a young picture of the Colonel Sanders. You'll always see this grey haired dude, and he was about 65 years old when he first started KFC, and the pictures were all of him being old. So if you think that you're too old, too young, I was 13 when I got excited about property, bought my first one at the age of 18. You're never too young or too old. If you are trying to get rich quick, good luck to you. Let me say, getting rich quick isn't something I've been able to come across. If your definition of quick is 5 to 10 years, then anything's possible. I was the kid that got the 2.8 in my UAI, which I put up on the screen earlier, and I earn more than my kids would have earned in the whole working career every year as passive income. So it's something that was in a period of 10 years. Myself, always focus on buying properties, as I said, with my 3 main goals beforehand. Buying a property that's below market value, having a strong cash flow, and upside to capital growth. If it's missing one of those things in any deal, I would not buy the deal and I would walk away from it. Just recapping on the property fundamentals, buy it in line with your goals. Make sure that if your goal is to buy 10 properties to yourself, 50 grand a year passive income or 100 grand a year passive income, whatever the goal may be, make sure that each property is a strategic step in being able to get you there to financial independence. Make sure you're buying the right properties, buying them below market values, upside to capital growth, buying capital cities, know your numbers and ensure a strong cash flow. I keep repeating myself because that's what we need to drill in our heads to make sure that we've got the right properties. Bingo hasn't started yet. You can see people putting their hands up. I know there's numbers on the screen and all that sort of stuff. Bingo will be on in about 15 minutes, I think. That's why I've been talking really fast to try and get through this. With this property, I thought at the start of the slide, I wanted to put up on the screen a few more properties that are similar to the ones that I bought. I've got clients that have got 20 properties, 50 properties, 60, 70 properties that have built over 3 years, 5 years, 2 years. my receptionist in my office at B.Invested headquarters, she was a client, so you call up my phone, 1300 number, speak to Linda. She's got 20 properties in the last, I've even known her for 2 years. She was a client for a year, she lost her job, I needed staff in my office. I want everyone in my office to be on the same page as what I am, so I employ my clients because they have an understanding of what I'm trying to achieve and the culture that I build. Like 20 properties in 12 months, 18 months, 2 years. These are the sort of properties that people are buying currently in the marketplace. Brisbane, you can't even build a townhouse like this for this price. This was purchased about a week ago, 172 grand. Current market value 210,000. Equity 32,000. It's rent at 7.5%. Wipes its own nose. It's got a heart, lungs, respiratory system. It's working for itself. It doesn't need you to go and dip into your pocket every week and pay for it. And I talk about those numbers being up in council rates, interest rates, all those sorts of things. It looks after itself. If that rent goes from $250 per week to $350 per week in the next 5 to 10 years, which is going to anyway, I don't like to speculate and talk about things going to go up like that and be flippant, but quite possible it will. And I've seen it happen time and time again with my own properties. If that was to be $350 a week, you'd be putting $100 a week in your pocket. You buy 10 of them, there's 50 grand a year passive income in your pocket. If it goes from 172 grand to 350 grand, you just made double your money as well. A bit better odds than the bigger that's going to happen a year later, get higher results, but here's a property in regional New South Wales. Purchase price, this one was one that we bought for a client last month, $92,000, 2-bedroom unit. 120,000 is the asking price, got it 30 grand below what the agent was asking. If you go on the net, have a look in the area, what's for sale, you won't find anything under 130, 140 at the moment. The rent on this should be about 190 to 200 per week, 10% yield. This property here, on the screen it looks like some alien sort of, green and blue and all that sort of stuff. On my screen it looks like a pool, about 6 pools in the bottom of a resort. This property is a unit development where a developer went bust, and I had the opportunity. There's 788 units in there. I went and negotiated the leftover stock. They were selling for 600 to about $1 million. They were pretty high-end sort of properties. The developer went bust. The bank took over and they disposed of the asset for the developer and finished the development side with about $500 million worth of development. I went in there and they were selling them down to like the 450,000 as the asking price when I started buying them. I went in there and negotiated all the remaining stock for average price about 320 grand. That means you're about 130 grand below what a full valuation was. And when I say full valuation, that was a bank valuation ordered by one of the big 4 banks. Valuation came from Herring & White, and they're a big valuation company, one of the biggest ones in the country. That's what they came in at. I've got the valuations, copies of them to prove it. From rental side of things, neutral cash flow, brand new with depreciation. I bought in there, my clients bought in there, and that's the sort of properties that are happening. Here's another picture of it. Once again, it looks better on my screen than their screen, but it's a big 40-storey building. There's 3 towers there. It's pretty cool. From my side of things, I'm not going to sit here and try and sell anything or anything like that. Lots of people want to ask questions, be able to build a strategy on themselves, being able to get themselves financial independence, get themselves out of the workforce and tell their bosses where to go come Monday morning. If you need a bit of clarity on that, in my office, my staff, my business partners, they're all property investors themselves. If you have any questions, you can sit with them on a one-on-one hour session to talk about your goals, what you're trying to achieve, and what strategies and any questions you've got. Just ask over. If you don't have any plans on selling anything to you, anything like that, normally it's $299, $199 for those of you that are here today. I'll be out the back door if anyone wants to come and chat and ask me questions, because I know I have to get off the stage in 2 minutes. I've got some brochures and stuff to hand you if you want to have a look at that. On that note, I'm going to get off the stage. If you want to take photos of this so you can go home when your internet's working again, hop onto YouTube and make some funny YouTube videos on a daily basis. Put up on YouTube and check out the Facebook page. So thanks a lot for your time today.
Ladies and gentlemen, put your hands together for Nathan Birch. Come on,